Inflation. What it is, how it can be controlled, and extreme examples. What you need to know about the purchasing power of money and how it changes. What is inflation? Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. The rate at which purchasing power drops can be reflected in the average price increase of a basket of selected goods and services over some period of time. The rise in prices, which is often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. Inflation can be contrasted with deflation, which occurs when prices decline and purchasing power increases. Key takeaways. Inflation is the rate at which prices for goods and services rise. Inflation is sometimes classified into three types: demand, pull inflation, cost, push inflation, and built-in inflation. The most commonly used inflation indexes are the Consumer Price Index and the Wholesale Price Index. Inflation can be viewed positively or negatively depending on the individual viewpoint and rate of change. Those with tangible assets, like property or stocked commodities, may like to see some inflation as that raises the value of their assets. 1.9. What is inflation? Understanding inflation. While it is easy to measure the price changes of individual products over time, human needs extend beyond just one or two products. Individuals need a big and diversified set of products, as well as a host of services for living a comfortable life. They include commodities like food grains, metal, fuel, utilities like electricity and transportation, and services like healthcare, entertainment, and labor. Inflation aims to measure the overall impact of price changes for a diversified set of products and services. It allows for a single value representation of the increase in the price level of goods and services in an economy over a period of time. Prices rise, which means that one unit of money buys fewer goods and services. This loss of purchasing power impacts the cost of living for the common public, which ultimately leads to a deceleration in economic growth. The consensus view among economists is that sustained inflation occurs when a nation's money supply growth outpaces economic growth. 6. The change in the Consumer Price Index for all urban consumers, CPU, over the 12-month period ending February 2023. Prices rose 0.4 on a seasonally adjusted basis in February from the previous month. 1. Inflation example. Investopedia, Julie Bank. To combat this, the Monetary Authority, in most cases the central bank, takes the necessary steps to manage the money supply and credit to keep inflation within permissible limits and keep the economy running smoothly. Theoretically, monetarism is a popular theory that explains the relationship between inflation and the money supply of an economy. For example, following the Spanish conquest of the Aztec and Inca empires, massive amounts of gold and especially silver flowed into the Spanish and other European economies. Since the money supply rapidly increased, the value of money fell, contributing to rapidly rising prices. 2. Inflation is measured in a variety of ways depending on the types of goods and services. It is the opposite of deflation, which indicates a general decline in prices when the inflation rate falls below zero. Keep in mind that deflation shouldn't be confused with disinflation, which is a related term referring to a slowing down in the rate of inflation. Causes of inflation. An increase in the supply of money is the root of inflation, though this can play out through different mechanisms in the economy. A country's money supply can be increased by the monetary authorities by printing and giving away more money to citizens, legally devaluing, reducing the value of the legal tender currency, loaning new money into existence as reserve account credits through the banking system, by purchasing government bonds from banks on the secondary market, the most common method. In all of these cases, the money ends up losing its purchasing power. The mechanisms of how this drives inflation can be classified into three types: demand, pull inflation, cost, push inflation, and built-in inflation. Demand. Pull effect. Demand. Pull inflation occurs when an increase in the supply of money and credit stimulates the overall demand for goods and services to increase more rapidly than the economy's production capacity. This increases demand and leads to price rises. When people have more money, it leads to positive consumer sentiment. This, in turn, leads to higher spending, which pulls prices higher. It creates a demand-supply gap with higher demand and less flexible supply, which results in higher prices. How does inflation work? Melissa Ling, Copyright Investopedia 2019. Cost. Push effect. Cost. Push inflation is a result of the increase in prices working through the production process inputs. When additions to the supply of money and credit are channeled into a commodity or other asset markets, costs for all kinds of intermediate goods rise. This is especially evident when there's a negative economic shock to the supply of key commodities. These developments lead to higher costs for the finished product or service and work their way into rising consumer prices. For instance, when the money supply is expanded, it creates a speculative boom in oil prices. This means that the cost of energy can rise and contribute to rising consumer prices, which is reflected in various measures of inflation. Built-in inflation. Built-in inflation is related to adaptive expectations, or the idea that people expect current inflation rates to continue in the future. As the price of goods and services rises, people may expect a continuous rise in the future at a similar rate. As such, workers may demand more costs or wages to maintain their standard of living. Their increased wages result in a higher cost of goods and services, and this wage price spiral continues as one factor induces the other and vice versa. Types of price indexes. Depending upon the selected set of goods and services used, multiple types of baskets of goods are calculated and tracked as price indexes. The most commonly used price indexes are the Consumer Price Index (PI) and the Wholesale Price Index (PI) and the Wholesale Price Index (BI). The Consumer Price Index (CP). The CPI is a measure that examines the weighted average of prices of a basket of goods and services that are of primary consumer needs. They include transportation, food, and medical care. PI is calculated by taking price changes for each item in the predetermined basket of goods and averaging them based on their relative weight in the whole basket. The prices in consideration are the retail prices of each item as available for purchase by the individual citizens. Changes in the CPI are used to assess price changes associated with the cost of living, making it one of the most frequently used statistics for identifying periods of inflation or deflation. In the U.S., the Bureau of Labor Statistics Police reports the CPI on a monthly basis and has calculated it as far back as 1913. 3. The CPI-U, which was introduced in 1978, represents the buying habits of approximately 80 of the non-institutional population of the United States. 4. The Wholesale Price Index, UP. The WPI is another popular measure of inflation. It measures and tracks the changes in the price of goods in the stages before the retail level. While DD items vary from one country to another, they mostly include items at the producer or wholesale level. For example, it includes cotton prices for raw cotton, cotton yarn, cotton gray goods, and cotton clothing. Although many countries and organizations use UPUWP, many other countries, including the U.S., use a similar variant called the Producer Price Index, PI. 6. The Producer Price Index, PI. The PI is a family of indexes that measures the average change in selling prices received by domestic producers of intermediate goods and services over time. The P measures price changes from the perspective of the seller and differs from the CPI, which measures price changes from the perspective of the buyer. 7. In all variants, it is possible that the rise in the price of one component, say oil, cancels out the price decline in another, say wheat, to a certain extent. Overall, each index represents the average weighted price change for the given constituents, which may apply at the overall economy, sector, or commodity level. The formula for measuring inflation. The above-mentioned variants of price indexes can be used to calculate the value of inflation between two particular months or years. While a lot of ready-made inflation calculators are already available on various financial portals and websites, it is always better to be aware of the underlying methodology to ensure accuracy with a clear understanding of the calculations. Mathematically, percent inflation rate HPI index value initial CPI value, X100. Say you wish to know how the purchasing power of $10,000 changed between September 1975 and September 2018. One can find price index data on various portals in a tabular form. From that table, pick up the corresponding CP figures for the given 2 months. For September 1975, it was 54.6 initial CP value, and for September 2018, it was 252.439 final CPI value. 8. 9. Plugging in the formula yields percent inflation rate 252.439.54.6 x 104.6,234 x 162.30 462.34. Since you wish to know how much $10,000 from September 1975 would worth be in September 2018, multiply the inflation rate by the amount to get the change dollar value. Change in dollar value 84.6,234 x $10,000 $46,234.25. This means that $10,000 in September 1975 will be worth $46,234.25. Essentially, if you purchased a basket of goods and services as included in the CP definition, worth $10,000 in 1975, the same basket would cost you $46,234. Teddy Fauci. Advantages and disadvantages of inflation. Inflation can be construed as either a good or a bad thing, depending upon which side one takes and how rapidly the change occurs. Individuals with tangible assets, like property or stocked commodities, priced in their home currency may like to see some inflation as that raises the price of their assets, which they can sell at a higher rate. Inflation often leads to speculation by businesses in risky projects and by individuals who invest in company stocks because they expect better returns than inflation. An optimum level of inflation is often promoted to encourage spending to a certain extent instead of saving. If the purchasing power of money falls over time, then there may be a greater incentive to spend now, instead of saving and spending later. It may increase spending, which may boost economic activities in a country. A balanced approach is thought to keep the inflation value in an optimum and desirable range. Cons. Buyers of such assets may not be happy with inflation, as they will be required to shell out more money. People who hold assets valued in their home currency, such as cash or bonds, may not like inflation as it erodes the real value of their holdings. As such, investors looking to protect their portfolios from inflation should consider inflation. Hedged asset classes, such as gold, commodities, and real estate investment trusts, REITs. Inflation. Indexed bonds are another popular option for investors to profit from inflation. High and variable rates of inflation can impose major costs on an economy. Businesses, workers, and consumers must all account for the effects of generally rising prices in their buying, selling, and planning decisions. This introduces an additional source of uncertainty into the economy because they may guess wrong about the rate of future inflation. Time and resources expended on researching, estimating, and adjusting economic behavior are expected to rise to the general level of prices. That's opposed to real economic fundamentals, which inevitably represent a cost to the economy as a whole. Even a low, stable, and easily predictable rate of inflation, which some consider otherwise optimal, may lead to serious problems in the economy. That's because of how, where, and when the new money enters the economy. Whenever new money and credit enter the economy, it is always into the hands of specific individuals or business firms. The process of price level adjustments to the new money supply proceeds as they then spend the new money, and it circulates from hand to hand and account to account through the economy. Inflation does drive up some prices first and drives up other prices later. This sequential change in purchasing power and prices, known as the Cantillon effect, means that the process of inflation not only increases the general price level over time, but it also distorts relative prices, wages, and rates of return along the way. Economists in general understand that distortions of relative prices away from their economic equilibrium are not good for the economy, and Austrian economists even believe this process to be a major driver of cycles of recession in the economy. 10. Leads to higher resale value of asset. Optimum levels of inflation encourage spending. Cons. Buyers have to pay more for products and services, impose higher prices on economy, drive some prices up first and others later. Controlling inflation. A country's financial regulator shoulders the important responsibility of keeping inflation in check. It is done by implementing measures through monetary policy, which refers to the actions of a central bank or other committees that determine the size and rate of growth of the money supply. In the U.S., the Fed's monetary policy goals include moderate long-term interest rates, price stability, and maximum employment. Each of these goals is intended to promote a stable financial environment. The Federal Reserve clearly communicates long-term inflation goals in order to keep a steady long-term rate of inflation, which is thought to be beneficial to the economy. 11. Price stability, or a relatively constant level of inflation, allows businesses to plan for the future since they know what to expect. The Fed believes that this will promote maximum employment, which is determined by non-monetary factors that fluctuate over time and are therefore subject to change. For this reason, the Fed doesn't set a specific goal for maximum employment, and it is largely determined by employers' assessments. Maximum employment does not mean zero unemployment, as at any given time, there is a certain level of volatility as people vacate and start new jobs. Hyperinflation is often described as a period of inflation of 50 or more per month. Monetary authorities also take exceptional measures in extreme conditions of the economy. For instance, following the 2008 financial crisis, the U.S. Fed kept the interest rates near zero and pursued a bond buying program called quantitative easing (QIQ). 12. Some critics of the program alleged it would cause a spike in inflation in the U.S. dollar. But inflation peaked in 2007 and declined steadily over the next 8 years. There are many complex reasons why Q didn't lead to inflation or hyperinflation, though the simplest explanation is that the recession itself was a very prominent deflationary environment, and quantitative easing supported its effect. 13. Consequently, U.S. policymakers have attempted to keep inflation steady at around 2 per year. The European Central Bank, ECB, has also pursued aggressive quantitative easing to counter deflation in the Eurozone, and some places have experienced negative interest rates. That's due to fears that deflation could take hold in the Eurozone and lead to economic stagnation. Moreover, countries that are experiencing higher rates of growth can absorb higher rates of inflation. India's target is around 4, with an upper tolerance of 6 and a lower tolerance of 2s, while Brazil aims for 3.5 with an upper tolerance of 5 and a lower tolerance of 5 and a lower tolerance of 2. Hedging against inflation. Stocks are considered to be the best hedge against inflation, as the rise in stock prices is inclusive of the effects of inflation. Since additions to the money supply in virtually all modern economies occur as bank credit injections through the financial system, much of the immediate effect on prices happens in financial assets that are priced in their home currency, such as stocks. Special financial instruments exist that one can use to safeguard investments against inflation. They include treasury inflation, protected securities, TIPS, low-risk treasury security that is indexed to inflation where the principal amount invested is increased by the percentage of inflation. 19. One can also opt for a TIPS mutual fund or TIPS, based exchange traded fund, ETF, to get access to stocks, ETFs, and other funds that can help to avoid the dangers of inflation. You'll likely need a brokerage account. Choosing a stockbroker can be a tedious process due to the variety among them. Gold is also considered to be a hedge against inflation, although this doesn't always appear to be the case looking backward. Extreme examples of inflation. Since all world currencies are fiat money, the money supply could increase rapidly for political reasons, resulting in rapid price level increases. The most famous example is the hyperinflation that struck the German Weimar Republic in the early 1920s. The nations that were victorious in World War I demanded reparations from Germany, which could not be paid in German paper currency, as this was of suspect value due to government borrowing. Germany attempted to print paper notes, buy foreign currency with them, and use that to pay their debts. This policy led to the rapid devaluation of the German mark, along with the hyperinflation that accompanied the development. German consumers responded to the cycle by trying to spend their money as fast as possible, understanding that it would be worth less and less the longer they waited. More and more money flooded the economy, and its value plummeted to the point where people would paper their walls with practically worthless bills. Similar situations occurred in Peru in 1990 and in Zimbabwe between 2007 and 2008-20. What causes inflation? There are 3 main causes of inflation: demand, pull inflation, cost, push inflation, and built-in inflation. Demand. Pull inflation refers to situations where there are not enough products or services being produced to keep up with demand, causing their prices to increase. Cost. Push inflation, on the other hand, occurs when the cost of producing products and services rises, forcing businesses to raise their prices. Built-in inflation, which is sometimes referred to as a wage price spiral, occurs when workers demand higher wages to keep up with rising living costs. This, in turn, causes businesses to raise their prices in order to offset their rising wage costs, leading to a self-reinforcing loop of wage and price increases. Is inflation good or bad? Too much inflation is generally considered bad for an economy, while too little inflation is also considered harmful. Many economists advocate for a middle ground of low to moderate inflation of around 2 CUA per year. Generally speaking, higher inflation harms savers because it erodes the purchasing power of the money they have saved. However, it can benefit borrowers because the inflation-adjusted value of their outstanding debts shrinks over time. What are the effects of inflation? Inflation can affect the economy in several ways. For example, if inflation causes a nation's currency to decline, this can benefit exporters by making their goods more affordable when priced in the currency of foreign nations. On the other hand, this could harm importers by making foreign-made goods more expensive. Higher inflation can also encourage spending, as consumers will aim to purchase goods quickly before their prices rise further. Savers, on the other hand, could see the real value of their savings erode, limiting their ability to spend or invest in the future. Why is inflation so high right now? In 2022, inflation rates in the US and around the world rose to their highest levels since the early 1980s. While there is no single reason for this rapid rise in global prices, a series of events worked together to boost inflation to such high levels. The COVID-19 pandemic in early 2020 led to lockdowns and other restrictive measures that greatly disrupted global supply chains, from factory closures to bottlenecks at maritime ports. At the same time, governments issued stimulus checks and increased unemployment benefits to help blunt the financial impact of these measures on individuals and small businesses. When COVID vaccines became widespread and the economy rapidly bounced back, demand, fueled in part by stimulus money and low interest rates, quickly outpaced supply, which still struggled to get back to pre-COVID level. Russia's unprovoked invasion of Ukraine in early 2022 led to a series of economic sanctions and trade restrictions on Russia, limiting the world's supply of oil and gas, since Russia is a large producer of fossil fuel. At the same time, food prices rose as Ukraine's large grain harvests could not be exported. As fuel and food prices rose, it led to similar increases down the value chain. The bottom line: inflation is a rise in prices, which results in the decline of purchasing power over time. Inflation is natural, and the U.S. government targets an annual inflation rate of 2s. However, inflation can be dangerous when it increases too much, too fast. Inflation makes items more expensive, especially if wages do not rise by the same levels of inflation. Additionally, inflation erodes the value of some assets, especially cash. Governments and central banks seek to control inflation through monetary policy. 10 common effects of inflation. Inflation is the overall rise in the prices of goods and services over time. The annual inflation rate in the United States averaged 3.27s between 1914 and 2022. 1. So moderate inflation has been a fact of life and the natural economic state for more than a century. That makes it important to distinguish between the inherent effects of inflation of any rate and those that only come into play during periods when inflation runs unusually high. We'll do that below in identifying inflation's most important effects on consumers, investors, and the economy. Key takeaways. Inflation, the sustained and broad rise in the prices of goods and services over time, erodes purchasing power. A small but positive inflation rate is economically useful, while high inflation tends to feed on itself and to impair the economy's long-term performance. Real estate, energy commodities, and value stocks have historically outperformed during periods of high or rising inflation. Conversely, bonds and expensive growth stocks tend to lag as inflation lowers the present value of their future cash flows to investors. 117. How can inflation be good for the economy? 1. Erodes purchasing power. This is inflation's primary and most pervasive effect. An overall rise in prices over time reduces the purchasing power of consumers, since a fixed amount of money will afford progressively less consumption. Consumers lose purchasing power whether inflation is running at 2 or at 4. They just lose it twice as fast at the higher rate. Compounding would ensure that the overall price level would increase more than twice as much over the long run if long-run inflation were to double. Inflation measures the rise in prices over time for a basket of goods and services representative of overall consumer spending. The Consumer Price Index, PI, is the best-known inflation indicator, while the Federal Reserve focuses on the PC Price Index in its inflation targeting. 2. Inflation, 20 years. 2. Hurts those with lower income disproportionately. Lower income consumers tend to spend a higher proportion of their income overall and on necessities than those with higher incomes, and so have less of a cushion against the loss of purchasing power inherent in inflation. 3. Policymakers and financial market participants often focus on core inflation that excludes the prices of food and energy, which tend to be more volatile and therefore less reflective of longer-term inflation trends. But earners with lower income spend a relatively large proportion of their weekly or monthly household budgets on food and energy, commodities hard to substitute or go without when prices spike. The poor are also less likely to own assets like real estate, which has traditionally served as an inflation hedge. On the other hand, recipients of Social Security benefits and other federal transfer payments receive inflation protection in the form of cost of living adjustments based on an index of consumer prices for hourly wage earners and clerical workers. 3. Keeps deflation at bay. The Federal Reserve aims for inflation of 2 over the long run to meet its mandates for stable prices and maximum employment. It targets modest inflation rather than aiming for steady prices because a slightly positive inflation rate greases the wheels of commerce, provides a margin of error in the event inflation is overestimated, and deters deflation. The overall decline in prices can be much more destabilizing than comparable inflation. 4. Inflation allows lenders to charge interest to offset the inflation likely to devalue repayments. Inflation also helps borrowers service debt by allowing them to make future repayments with inflated currency. In contrast, deflation makes it increasingly costlier to service debt in real terms, since borrowers' income would be likely to decline alongside prices. Because deflation represents a departure from the norm, it's also more likely to trigger expectations for additional deflation, causing further spending and income declines and ultimately widespread loan defaults that can set off a banking crisis. One reason modest inflation rather than deflation is the norm is that wages are sticky to the downside. Workers tend to resist attempts to cut their wages during an economic downturn, with layoffs the likeliest alternative for businesses facing a downturn in demand. 5. A positive inflation rate allows a wage freeze to serve as a cut in labor costs in real terms. The benefits of inflation are only insurance against deflation until price hikes exceed the customary and expected rate, because inflation can also spiral out of control if high enough. 4. When high, feeds on itself. As we've discussed, a little inflation can be a symptom of a healthy economy and not something that's likely to cause inflation expectations to rise. If inflation was 2 last year and is 2 this year, it's mostly background noise. Businesses, workers, and consumers would likely expect inflation to remain at 2 next year in that scenario. But when the inflation rate sharply accelerates and stays high, expectations of future inflation will eventually begin to rise accordingly. As those expectations rise, workers start demanding larger wage increases and employers pass on those costs by raising prices on output, setting off a wage price spiral. In the worst-case scenario, a bungled policy response to high inflation can end in hyperinflation. But there's no need to count the cost of soaring inflation expectations in wheelbarrow loads of Zimbabwe dollar notes denominated in trillions or in the Weimar Republic's worthless marks from Germany's 5 years of hyperinflation after World War II. In the U.S., rising inflation expectations during the 1970s lifted annual inflation above 13 by 1980 and the federal funds rate to more than 20 v. 1981. While unemployment topped 10 as late as mid-1983 following the ensuing recessions. 6. Inflation in Weimar Germany. By December 1923, an index of the cost of living in Germany increased to a level of more than 1.5 trillion times its pre-Y measure. 9. 5. Raises interest rates. As the examples above suggest, governments and central banks have a powerful incentive to keep inflation in check. In the U.S. and around the world over the past century, the approach has been to manage inflation using monetary policy when inflation threatens to exceed a central bank's target, typically 2 in developed economies and 3 to 4 in emerging ones. Policymakers can raise the minimum interest rate. driving borrowing costs across the economy higher by constraining money supply. 10. As a result, inflation and interest rates tend to move in the same direction. By raising interest rates as inflation rises, central banks can dampen the economy's animal spirits or risk appetite and the attendant price pressure. Suddenly, the expected monthly payments on that boat or that corporate bond issue for a new expansion project seem a bit high. Meanwhile, the risk-free rate of return available for newly issued treasury bonds will tend to rise, rewarding saving. 6. Lowers debt service costs. While new borrowers are likely to face higher interest rates when inflation rises, those with fixed-rate mortgages and other loans get the benefit of repaying these with inflated money, lowering their debt service costs after adjusting for inflation. Say you borrow $1,000 at a 5 annual rate of interest. If annual inflation subsequently rises to 10, the annual decline in your inflation-adjusted loan balance will outweigh your interest costs. Note that this doesn't apply to adjustable rate mortgages, credit card balances, or home equity lines of credit, which typically allow lenders to raise their interest rate to keep pace with inflation and Fed rate hikes. 7. Lifts growth, employment in the short term. In the short term, higher inflation can lead to faster economic growth. While the 1970s are recalled as a decade of stagflation, U.S. real gross domestic product, GDP, increased 3.2% annually on average between 1970 and 1979, well above the economy's average growth rate since. 11. Elevated inflation discourages saving, since it erodes the purchasing power of the savings over time. That prospect can encourage consumers to spend and businesses to invest. As a result, unemployment often declines at first as inflation climbs. Historical observations of the inverse correlation between unemployment and inflation led to the development of the Phillips curve expressing the relationship. For a time at least, higher inflation can spur demand while lowering inflation-adjusted labor costs, fueling job gains. Eventually, though, the bill for persistently high inflation must come due in the form of a painful downturn that resets expectations, or else chronic economic underperformance. 8. Can cause painful recessions. The trouble with the trade-off between inflation and unemployment is that prolonged acceptance of higher inflation to protect jobs may cause inflation expectations to rise to the point where they set off an inflationary spiral of price hikes and pay increases, as happened in the U.S. during the stagflation of the 1970s, to regain lost credibility and convince everyone again it would control inflation. The Federal Reserve was subsequently forced to raise interest rates much higher and to keep them high longer. That, in turn, caused unemployment to soar and to stay high for longer than would likely have been the case had the Fed not allowed inflation to spiral so high. 12.9. Hurts bonds, growth stocks. Normally, bonds are lower-risk investments providing regular interest income at a fixed rate. Inflation, and especially high inflation, impairs the value of bonds by lowering the present value of that income. 14. As interest rates increase in response to rising or elevated inflation, so does the yield on newly issued bonds. The market price of bonds issued previously at a lower yield then drops proportionally. Since bond prices are the inverse of bond yield, investors holding a treasury bond are still in line for the expected coupon payments, followed by principal repayment at maturity. But those selling before maturity will receive less as a result of the increased market yield. There is less of a consensus about whether high inflation hurts or helps stocks overall. Conclusions will depend on the definition of high inflation and whether the historical record cited includes the 1970s, a lost decade for it. Stocks amid stagflation. 15. Growth stocks, which tend to be more expensive, are notoriously allergic to inflation, which discounts the present value of their future cash flows more heavily, just as it does for high-duration bonds. Technology and consumer stocks have lagged during past episodes of high or rising inflation. 16. 10. Boosts real estate, energy, value stock. Real estate has historically served as an inflation hedge, since landlords can protect themselves against inflation by raising rents, even as inflation erodes the real cost of fixed-rate mortgages. And while rising commodity prices can cause inflation to accelerate, once it does, commodities, and in particular energy commodities, tend to continue to outperform, though that can change when growth slows. 17. Unsurprisingly, energy equities, real estate investment trusts, and value stocks have historically outperformed during episodes of high or rising inflation. 18. What is inflation's primary effect? Inflation causes the purchasing power of a currency to decline, making a representative basket of goods and services increasingly more expensive. How can inflation benefit homeowners? Homeowners with fixed-rate mortgages benefit from inflation because it discounts the present value of their future mortgage payments. As housing prices rise as a result of inflation, home equity increases. Finally, homeowners who rent out their homes can increase rents with inflation. What is deflation? Deflation is a sustained period of broadly declining prices. Deflation is often the result of a severe economic contraction that causes consumers and businesses to curtail spending and investing. Deflation is destabilizing because it makes it harder to service debts.